3, 2, 1, let's go.
Getting fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich.
Great.
Damn it, we're gonna be so fucking rich.
I have to with everybody. You don't have to.
Griffin, I want my fucking money.
You're an original,
Hey,
aren't
yelling,
you?
cowboy. Me the fucking money. Get the goddamn money printer out.
Great. Bounty better.
We're gonna be so fucking rich. Get the goddamn money printer out. I think one time we'll do. What's up, everybody? How you doing? It's good to see you. Before we start, I'd just like to say one thing. Ken Griffin, where's my fucking money? Jesus. Pay up, motherfucker. I want my fucking money. 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 I want my fucking money. Gary Gensler, I want my fucking money. I'm just having a good time. I hope everyone's having a good time as well. Happy Friday. It's been an interesting week, huh? What's up, Megan, Donald, Aaron, everybody? Thanks so much for coming. Hayden, Pam, Floyd, Carlos. Appreciate you guys. What's up, Oliver? Thanks for coming out. Thanks for waiting patiently. I was handling some business, taking care of some phone calls. Sorry we're a little late, fashionably late as always. But everything's caught up. So we can talk stonks. So these are investors with a positive credit balance, and these are investors with a negative credit balance. Credit balance is calculated as the sum of free credit cash accounts and credit balance in margin accounts, all right, minus margin debt. You can see in October of 2000 during the dot-com, let's just say debt was pretty bad. The blue line is the monthly close of the S&P 500 starting back in 1980s. 1980. Using the most up-to-date data. Even in June 2007, you can see in the dot-com bubble, this is how bad our leverage and unrealized losses and negative credit balances were. Here you had the Fed bubble. As you can see, it runs perfectly inverse to the S&P 500. May 2018 crash. This is what happened right before we had the 2018 and 2020 crashes. But as you can see, it's worse than ever now because the printing of artificial money got so far out of control that it's just thrown everything out of proportion here. It's the Shiller PE ratio. Let me slide this over here, see if you can't, if you're missing some of the screen here. I can actually adjust this. Let me fix this. There you go. That should give you a little bit of a better vantage point on this. But the Shiller PE ratio is currently 51.9% higher than the recent 20-year average. The implied future annual return is negative 5%. And even the most recent 20-year low is at 13.3%. This is pretty bad here. Let me see. This Guru Focus has added a new metric that we haven't used before called the excess cape yield. It's the ECY. It was introduced by Dr. Robert Shiller, the creator of the Shiller PE ratio, a Nobel Prize winner, to give a more precise picture of the stock market. So, Robert Shiller of Yale invented this to basically value the stock market. It's a more reasonable market value indicator than the price to earnings ratio because it eliminates fluctuations caused by variations of profit margins during business cycles, and it also accounts for inflation. Let's see, down here it says, for your information, this is similar to market valuation based on the ratio of total market cap over GDP, where the variation of profit margins does not play a role either. So this is really helpful for evaluating not only single stocks, but entire sectors. And when you use the Shiller PE ratio on the S&P 500, it's out of control. All right, the Shiller PE ratio, higher this is, the more overvalued stocks are, their price to earnings, just in general. This was 2020, January 1st, before COVID crash. This was January 2018, before the 2018 market crash. And as you can see here, back in October of 2007, it was a healthy 27. Much, much lower than the current 39 we're seeing as of December 10th, 2021. Check this out here. See, so they use the annual earnings of the S&P 500 over the past 10 years. They adjust the past earnings for inflation using CPI and adjust it into today's dollars. The averages are adjusted for the various values, and it equals the ratio of the price of the S&P 500 index over those values. So as you can see here, during economic expansions, companies have high profit margins and earnings. The PE ratio becomes artificially low due to higher earnings. During recessions, profit margins are low and earnings are low. Then the regular PE ratio becomes higher. Check it out. This is the regular PE ratio, not the one from Dr. Robert Shiller that we see here. Again, in this one, this runs inverse. So the higher this is, the more likely the market is to crash because of over leveraging and overvaluation instead. That's a better term for it. The regular PE ratio we saw was in the 25 and 26 range up until September 1st of 2008, in which it started just the regular PE ratio in April 2009 shot up to 119.8, when the all-time historical average, as you can see, is 16. Pretty easy shit, right? January of 2021, during COVID, we hit 36. I think we're going to be eclipsing these pretty soon, making that 129 look very healthy when it's not. The highest peak from the regular PE ratio was 123 in the first quarter of 2009. The S&P crashed more than 50% from its peak in 2007. Take a look. And this is what happens. It was the best time in recent history to buy stocks immediately after when the price to earnings, the Shiller PE ratio was at 13.3. It correctly indicated a much better time to buy stocks. Here's the implied market return. All right, on something like this, when you're looking at this implied market return, sorry, I wait for them to finish talking in the background there. The current expected return as of December 10th, 2021 is negative 0.7. That's the return percentage. And up until recently, we could see here September 2013 and October 2013, the actual return was at 12.6. The expected was at 5.7. Again, currently at negative 0.7%. Looking further back, the expected return in 2008 was kind of outrageous. See, so we could basically estimate using the Shiller PE's current level that the future market return will be around negative 5.1% per year. Now that's based on stocks that don't run. Those are based on standard stocks, blue chips that don't run inverse to the market, not heavily shorted stocks, just regular stocks, and the entire indices themselves. Check out the excess cape yield. Excuse me a minute. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich.
Great.
Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money. Get the goddamn money printer out.
Great.
Yo, what's going on, people? Sorry for the delay there. I had to put the brakes on for a second, go check on something. Check out the excess cape yield. Dr. Shiller says that as the Shiller PE keeps increasing, Dr. Robert Shiller recently introduced a new metric called excess cape yield. The ECY is calculated by the inverse of the Shiller PE, which is really the Shiller's earning yield subtracted by the United States 10-year Treasury bond yield. It's usually treated as a risk-free rate. The principle behind it is that the interest rate, commonly used as discount rate in stock valuation, can be essentially a component influencing equity prices. When the interest rate goes up, a lower discount rate tends to drive the stock price higher and push up CAPE ratios. Thus, the ECY is introduced to capture this effect. This number indicates the margin that stocks are paying over bonds. The higher the ECY is, the more attractive the stock market is relative to the bond. This is the ECY and actual 10-year annualized excess return of the stock market. That's pretty fucking low as of December. You don't have to be very smart to figure that out, right? You can see it. Take a look at 2018 during the market crash, 1.61. And even now, when we're just in a recession, not in any other sort of... The excess CAPE yields is at 3.17, and the 10-year returns previously at 13.15. When we're looking at a return of what we're expecting shortly to come as of negative 0.7%, which is about a negative 5% per year. So you can use the Shiller PE ratio on the SPY, for example. And when you pull up the S&P 500 PE ratio, you can see that it's currently at a 29.4. Again, the only times it was higher was right before the 2018, right before the COVID crash, right before the real estate bubble of '08, and right before the dot-com bubble of 2000, and immediately preceding that. I can't even fucking believe this shit anymore. It's so ridiculous that they've allowed this to get to this point. I just can't fucking believe how bad this has gotten, how out of control this has gotten. Check it out, guys. So what is a derivative? It is a time bomb and an accident waiting to happen. A nuclear financial bomb which will destroy the financial system. A financial instrument whose value is derived from an underlying asset. For example, the US dollar is a derivative. I know that you probably don't know this, but literally the money that you use every single day is a fucking derivative. Its value was once derived from gold or silver held at the Treasury, and those coins were minted by the United States government and placed in circulation. Decades ago, before 1971, you could take $1 to a bank and demand a coin of gold in exchange, or silver, or whatever the value it would be. This is a little outdated, because at the time, the value of the derivatives market was $144 trillion, which is about 2 times the world's global gross domestic product. And today, our derivatives market is worth $426 trillion. So it has 4x'd since this writing, which was in 2000 let's see here, just after 2008. See, so for example, I want to bet on whether our neighbor will default on his mortgage. Is the bet an asset? Does it have value? No, it doesn't. It's not an asset whatsoever. The paper dollar that you use every day is not an asset. Neither is this derivative. It's just a bet. And that's what all these derivatives are that are on this market. It's literally gotten to the point that thanks to Wall Street's power, the derivative is the main thing that's propping up our financial markets. That's fucking sad. So let's put this into perspective, okay? The notional value of the derivative market was roughly 1.4 quadrillion and $144 trillion. Yeah. We just busted out a W. Quadrillion. How much is that? 40 times the entire world stock market. 10 times the value of every stock and every bond on the planet. 23 times the world's gross domestic product. This is from goldenomic.com, Education Hall. You can check it out for yourself. goldenomic.com/education hall. I've been to this website many times in the past. And this is several years old. This is about a decade old at this point. The value of this market is now not 1.4 quadrillion, but around 4 quadrillion and $426 trillion in derivatives. You have to include the shadow banking sector. These are the top 25 commercial banks. JP Morgan, Goldman Sachs, Citibank, Bank of America, Wells Fargo. They have $183 trillion in derivatives off these, 882.4 off these top banks. And off all 1,389 banks that trade derivatives, there's 183 trillion, 501 billion, $158 million worth of derivatives. Because this number gets multiplied by a million. Because this table is expressed in millions. Let me zoom in case you can't see it. In millions of dollars. So you have to multiply each one of these numbers. 53 million times a million equals 53 trillion. And that's $53 trillion in derivatives for JP Morgan and only 3.1 trillion in assets. Aside from that, you got to look at their holding companies. Those holding companies are regulated by the CFTC, the Commodities Futures Trading Commission, offshore, outside of the United States. This is the shadow banking sector. Right fucking here. JP Morgan's shadow bank has an additional $52 trillion in derivatives on top of their original bank. This is their legal identifier. This proves to you that it is different from the one that I showed you above. This is in addition to the one shown above. So all in all, the derivatives between the JP Morgan Chase's derivatives are over $105 to $110 trillion, and they've only got about $7 trillion in total assets. When you take their shadow banking sector, their offshore accounts and holdings held that are regulated by the Commodities Futures and Trading Commission, and you combine that with their holdings here in the States, the actual banks themselves, to add these up. And you've got Goldman Sachs right behind with $47 trillion in derivatives and only 351 billion measly dollars in assets. You go and you could pull Goldman Sachs holding companies, and you can see that they're not faring much better over here either. They've only got $1.38 trillion in assets and $43.23 trillion in derivatives. This is an additional $244 trillion, $359 billion, $850 billion. What's up, Hobby, Pam? Thanks so much. Appreciate you guys. Appreciate my mods. For those of you guys that are unaware, this is wash trading. Basically, selling a stock from my right hand to my left hand. All right? Check it out. See this trade? This trade is being made for this exact amount in order to wash this many shares to move the price up or down ever so slightly. 262 shares for sale. Ask 31.87, and I'm sorry, the bid is 31.87, and the ask is 31.92. And there's a share, the exact same number of shares. Here you've got the next one at 31.86, coming in right behind, being picked up for 31.97. Again, right behind it with 31.85, coming in to pick it up at 31.98. So this is what causes manipulation of pricing either up or down regarding which way the algorithm wants to stair step. There's not hundreds of people trading 262, selling 262, 362, 162, 262, 263, 262, and 62 shares all at the same time, while other people are just randomly coming up with 262 purchases at 31.87. Somebody else just happens to want 262 shares at 31.86. Another person wants 162 at 31.85. And another one wants another 162 at 31.84. Does this sound natural? Absolutely not, because it's not. This is wash trading. Citadel was fined by FINRA $512,000. I'm sorry. They were fined $150,000 for committing over 500,000 wash sales. That's like 28 cents for wash sale. 28 cents a piece on average. Trading revenues are down for banks. In the second quarter, trading revenue decreased by almost 41%. You see that? This is from the quarterly report on bank trading and derivatives activities. Jesus Christ. And as we stated earlier, 4 large banks hold 88.7% of the total banking industry notional amount of derivatives, now valued over $426 trillion in actual value, but their notional value is ridiculously more. This was the derivatives market from June of 98 through October of 2007. At this point, it's off the charts, off the top of my screen, coming out the top of my fucking house. What other factors are coming at play into the stock market right now? Inflation, hyperinflation. What do we see in 2008? In 2008, preceding the market crash, we saw 4.2, 5.0, 5.6, and 5.4 CPI. 4 months in a row before we started coming down to 4.9 after the stock market began to crash. We're currently seeing 4.2, 5.0, 5.4, 5.4, 5.3, 5.4, 6.2, and 6.8. A lot of people are fucked. A lot of people are gonna die, sadly, because of famine, starvation, the inability to afford the massively fast and almost exponential rise of inflation at this point. One of the main leading factors that caused inflation was the artificial printing of money by the Federal Reserve, to the tune of 25% of all money in existence was printed in the last 6 months. In the last 6 months, 1/4 of all American money was printed. In the last 6 months, 25% was fucking printed and issued digitally by the Federal Reserve. Is it sinking in yet? Do you guys realize when you take in that first factor about artificially printing so much money and you add in supply and demand with supply chain issues that are completely out of control, the ports are more busy than ever, at least LA, LGB, Los Angeles, Long Beach ports in the United States are ridiculously busy. Ships are getting sent to all different ports on the West Coast, East Coast, Panama, through the Panama Canal, all sorts of shit, in order to try to get unloaded, and they still can't manage to keep up. This is continuing to compound. I own a trucking company and a logistics company, and I can attest that things have not gotten better. Things are getting worse. Trucking rates are down slightly over the last couple months, but that's only because, but that's a good thing. That's a good thing. That there's many reasons why, and I won't get into those right now, but it's not going to continue. Rates are going to stay the same or get worse, especially drayage, intermodal drayage rates are going to get out of control. They already are out of control. They're up almost 400% to get something from China to the United States. Now, you take these $426 trillion in total derivatives and the fact that we have so much of negative balance, I can't even put it on my fucking screen. Right? This is the S&P 500 monthly close, running inverse to a negative credit balance for investors and banks. And you take all of these items together, you throw in a bank like Evergrande, who has hundreds of billions of dollars in dollar notes issued of their dollar notes to other banks internationally, 129 banks internationally. That leaves BlackRock, HSBC, Ashmore, holding big bags of garbage, big piles of fucking trash. But until then, until they're completely actually in bankruptcy court through the Cayman Islands, those big bags of trash still maintain their same notional value. Because I realize that Evergrande dollar notes they're Chinese. They don't fall under the haircut qualifications and regulations, the new haircut regulations from the SEC and the Securities Exchange Commission. Evergrande dollar notes are separate. So that means that for $100 million, Ashmore can get $500 million worth of bonds and use it as $500 million of collateral. So it only costs 20% of the actual price. So even if it only lasts a month or two, that's about as long as they really need it to last for them to maintain this collateral game up as long as they can. Check this out. These are IMM dates. International money market dates are the 4 quarterly dates of each year in which Eurodollar and foreign exchange futures contracts and option contracts use their scheduled maturity date or termination date. They're the third Wednesday of March, June, September, and December. We talked about this in September, and we're going to talk about it again because dates are important. You don't bet the farm on them because that would make you a dipshit, but they're important because you need to know what's happening in the stock market in the world, and when things such as shorts, futures contracts, option contracts like these are being fucking closed out. These are collateralized debt securities. They're credit default swaps. Okay? So for you, those of you that are unaware, from late 2002, the collateralized debt swap market began to standardize default swap contracts so they would all mature on one of 4 days of March 20th, June 20th, September 20th, and December 20th. These dates are used for termination dates for the contracts and for the quarterly premium payments. So, for example, a 5-year contract traded any time between September 20th of 2005 and December 19th of 2005 would have a termination date of December 20th, 2010. In December 2015, the roll was reduced to semi-annual. So now it's only in September and March. So we no longer have the quarterly roll dates, but they're still able to be purchased and rolled, and often are on the quarter days in order to balance books better. Right here. Contracts are frequently rolled on the IMM dates, making them amongst the highest volume trading days of the year. And they also trade on settlement, so they're like T2 settlement as well. This is the overnight repurchase, the RRP, the reverse repurchase and the repurchase program by the Federal Reserve. Let's scoot this shit over here so you guys can see a little bit better. Yo, what's up, guys? You mind if I hop in here?
Yeah, you're all good.
Awesome. All right, cool. This is the reverse repurchase agreement. I'll share my screen in the Discord so you guys can follow along.
Yes, sir.
This is the overnight RRP reverse repurchase again. Friday, December 10th, 2021, we saw $1.5 trillion held in the reverse repurchase. It's overnight lending of securities. The bank takes the bank takes the securities, these garbage swaps and junk bonds, I should say, from the Federal Reserve for X amount of money and overnight. And the following day, the Federal Reserve returns the money plus 0.05% in exchange to get those junk bonds back. This is done to maintain liquidity because of the new regulations requires the top 34 banks to maintain $1 trillion on hand at all times to protect against losses and to be able to pay losses when they occur, such as when AMC and GameStop fucking run. The last time that the repurchase was used prior to this was in 2020, and it only got up to $284 billion. And again, we're at 1.507 trillion now. What does that tell you? Back in the mid 2013s to 2018, we were using it to the tune of 468 billion. That was the highest it got at that time. We have eclipsed that long, long ago. We really have. In 2008, it was at 25 billion. You know, like the more and more time that they've had to abuse this, the more that they've had to take these losses and use this as a financial tool to maintain liquidity. That's all this is. The 3-month Treasury bonds from the United States are worthless. 3-month bonds are worth 0.6%, I bet. Because it went up by 0.1 or something like that, you know? I forgot to type in USA. Excuse me. Yep. 0.06%, down over 22% from last year, which was down from the year before that, and the year before that, and the year before that, and so on. And the same can be said for 10-year bonds, 20-year bonds, 30-year bonds, and anything in between. Look at what happened in March. You know, the 3-month bond went from 2.4, 2.6, 2.5% to negative 0.05. Today sitting at 0.06%. When we take a dip off of this roller coaster, it's not going to be negative 0.05. This is going to be negative several percent. Negative several percentage points on 3-month bonds. So why would a bank, an institution, hold bonds that are so far negative when overnight they could hold their money in the bank and get positive 0.05%? That'd be like giving the government $200 in exchange for some securities, and the next day they give those securities back, and the Federal Reserve gives the bank $201. They made $1, but they didn't lose. They didn't lose. They were able to keep it on hand, and it counts towards their collateral values. Well, don't need that anyway. You can see it by the day here. Let's take a look at the 30-year. Is at 1.88%. Are you going to invest your money in a 30-year T-bill for 1.8%? No. Absolutely not. A 10-year Treasury rate, the T-bills are 1.48%. It's complete and utter trash. The 1-month Treasury rate is at 0.03. Why would they put it in the bank for 1 month for 0.03 and potentially lose the vast majority of it when they could repo it overnight for 0.05? and there's less risk because they only hold that hot potato for 24 hours. You guys want to see something interesting? The only time you've ever seen GameStop or AMC really get high short interest is when Melvin Capital forgot that they weren't supposed to short GameStop directly, and their short interest ran to 218% or so. What they're doing now is committing wash sales, abusing exchange-traded funds, abusing depository receipts in Brazil, Germany, Luxembourg, and everywhere in between. And that prevents the stocks from showing short interest because we're not shorting AMC or GameStop directly. We're shorting IWM and all these other funds. All these ETFs contain AMC, and there's more that I couldn't find. These are from my girl Kenna over at the Bull House. Make sure you guys follow the Bull House on YouTube and Twitter, and Kenna as well. They're awesome people. These are ETFs that hold GameStop. All of these here hold GameStop. Every single one of them. Most of them as their number one holding. All of these ETFs hold both AMC and GameStop as their number 1 and 2 holdings. So MXDU, ITOT, BUZZ, BBMC, AVUS, all of these can go and be shorted. So if VV cost to borrow is too expensive, we'll just switch over to SCHA, and then we'll short the fuck out of that. And then that cost to borrow starts getting too expensive, we'll move over to ESML and short that for a while. And they want to trade them against each other, so they could short TAAG or IWM. And then they could pump one of these other ETFs that holds GameStop, for example, and then create varying price differentials in order to keep one down if it's having earnings, for example. But they don't want to short it directly because that shows up on Ortex data. But if they do this, it doesn't show up on Ortex data whatsoever. Because you're not looking at the Ortex data for AVUS, BBMC, BKSE, BUZZ, DWAS, ES, and so on. I'm not going to be so facetious as to name every single one of them. But you get my fucking point, right? They're right here if you want to look at them. Fucking take a screenshot and go look them up. Oh, wait a minute. I already did that for you. Here's IWM. Okay, owned by BlackRock. BlackRock is not our fucking friend. iShares Russell 2000 ETF. Let's take a look at it. $68 billion worth of assets in this fund. Triple B rated. And AMC Entertainment Holdings, number 1. $357,469,554.90 worth, to be exact, is their market value of AMC. How many shares is that? 12,134,065. So when you guys see that there's not a whole lot of shares left to borrow on AMC, that's a good thing. But then they're borrowing these 12 million shares. These ETF from, then they're borrowing shares from iShares ETF, stock ticker symbol IWM. And that has the effect as if they were shorting, these 12.134 million shares. It has the same effect on the stock at the end of the day, as well as all the other ones. So if they were to, when this gets shorted, for example, AMC as well as Avis, Lattice, Crocs, Synaptics, Oventive, Silicon Laboratories, Saya Inc., all of these get shorted. And if they get pumped, then all of these get pumped as well. And as a matter of fact, I've got to go to my Twitter because I've got something interesting to show you guys. Again, here's all the ETFs that are holding AMC. I'm not sure if it's behind me at this point. Yeah, it looks like it is. Let me scoot that shit. Just leave it where it was before. There you go. Let me just get this shit out of your way. Make things easier. Looks like I've got some friends currently editing this. That's great to see. Good to hear you. Good to see you guys over here, always updating the info. Again, make sure you guys are following the Bull House on YouTube and on Twitter. They've also got a website if you want to check them out. They got a great magazine. Go over to my Twitter messages real quick so I can pull that up for you guys. You're going to see, I'm about to show you guys something that Reddit, oh, I'm sorry, you know what, here it is. But I'm going to show you guys after this how Reddit and why Reddit is purposely suppressing many posts. And I'm going to show you a post that they're suppressing right now. Who wants to see how many shares are left for IWM to be borrowed? December 10th, 2021, as of 2049 UTC time, there are 0 shares left of IWM to short. Earlier in the day, there was 200,000, previously 100,000, previously before that 900,000, then 1.1 million before that, 1 million before that, and so on. They were in the millions up until now. Right now, IWM has 0 fucking shares left to short. That's this ETF right here, iShares Russell 2000, which AMC is the #1 holding. Why? What is the one-day change? Down 2.26%. Because iShares was being shorted. There's no shares left to borrow because they borrowed them and shorted the fuck out of it. That brings the price of IWM down, which brings the price of AMC and everything in IWM down. Your favorite stocks aren't being shorted because they're not fundamentally sound. They're not being shorted because apes are selling. The price is going down because they're being shorted. They're borrowing millions of shares. 11 hours ago, there was 1.1 million, and now there's 0. And they're shorting the fuck out of them to bring the stock price on AMC and GameStop and all these others fucking down. See? It's a fucking beautiful thing. It's a beautiful thing when you know the stock that you're in, that the price doesn't really matter at the end of the day, because at some point it's going to go exponentially parabolic. Now, Charles Schwab has the last time we saw Charles Schwab adjust margin was in June of 2021. Now, as of yesterday, December 10th, 2021, my guy Artie Bacardi over on Twitter posted Charles Schwab just announced newly elevated requirements for shorting our stocks. And he's correct. Because I did my due diligence and I looked it up, and they have made changes. It's not the same update that they made in June. This is a new update that also includes stocks like AMC, GME, and DWAC, which in June, DWAC was not heavily shorted and was not on this margin requirements list. I'm sorry, it probably was heavily shorted, but it had not yet run to its extent that it has now, so it was not known about as well. So Charles Schwab is going to be issuing margin calls. AMC has gone up for 100% margin requirement for long position and 200% margin requirement for short positions. They still permit long calls, puts, and covered calls, and you can still sell short put options if you have the money and the percentage margin. Selling naked calls is permitted if you have available funds for increased requirements. And at any moment, this could turn into 300, 400, 500, and 1,000. And that's how people get margin called and defaults. GameStop, 100% margin requirement for long position, 300% margin requirement for short positions. Long calls, puts, covered calls are permitted. Selling short put options is permitted if you have funds available to cover the entire amount of the exercise. So not only do you have to sell a short put option, but you have to be able to exercise the entire put option, and you can't sell. Let me see. Okay, here it is. The below part about selling naked calls is permitted if you have available funds for increased requirements as well. So just more fucking bullish news. Again, the last time we saw this was in June, before the June run-up of AMC and GameStop and all these other stocks, including DWAC. And now we're going to see another June run-up. I don't know about the other stocks. I focus my due diligence on AMC and GameStop because I've noticed that they've got billions and billions of synthetics and absolutely billions and billions of divorced puts, married puts. And this takes short interest out of the hedge funds, and they buy and they create these married puts and divorced put spreads through the market maker. This turns short interest on AMC and GameStop into failures to deliver that have to be delivered on the date of these options. God damn, we're gonna be so fucking rich. Drop a like if you found some value in this. Subscribe if you learned something. Oh, here's something fun for you guys. This is from one of my friends, OG, here in the chat. In the Discord, and my other buddy Yasar as well have been working on this on Wealthsimple. They have placed stop limit sell orders for $69,000, and they're sitting. They have not gotten canceled. Here's another one from my other buddy, a stop limit sell pending for $69,000 US for one share, and he has since gone in and made changes and set it to sell 100 shares at a certain price. So I think that's fucking sexy right there. I don't think there's anything wrong with selling one share for $69,000 if you got hundreds of others and maybe thousands of other shares as well. Nothing wrong with selling 1% of your fucking holdings, in my opinion, if you're fucking making a shitload of money and securing some profits, locking in some profits. And nothing wrong with setting a sell order, as long as you don't sell a stop limit order, for example. But these here are stop limit sell pendings because they're so high up. He's not going to get caught underneath the trade price because the trade price has to get up there. And if he sells one share for $69,000, I highly doubt he's going to kick himself in the ass. He's got plenty of other fucking shares still. He's not going to give a fuck. He's going to be happy. Again, $244 trillion plus 183.5 trillion. Derivative contracts remain concentrated in interest rate products like reverse repurchase program and collateralized debt securities, which represented 72.6% of total derivative notional amounts. So almost 73% of total derivative notional amounts are held in these interest rate products like the reverse repurchase and CDOs, mortgage-backed securities, and bullshit like that. Now, if you guys notice, I keep stopping. This shit. This shit is not easy to talk about.
We just don't dance.
When you really think about it, if you understand what this means, you should be really worried. There have recently been many Brazilian depository receipts, among other things, issued on stocks like AMC and GameStop. An unsponsored Brazilian depository receipt program can be launched without the support of the underlying company, and the securities are traded on BMNFBOVESPA, which is the Brazilian market. The depository institutions that issue level 1 Brazilian depository receipts are responsible for disclosing information to the market. Although the program is registered with the CVM, the foreign issuers of shares are not required to register the company with the CVM. What does this mean? This means that for every share that Citibank, the one and only, has of AMC, they can issue 6 depository receipts of A2MC34, unsponsored Brazilian depository receipts. These are certificates representing shares of foreign companies traded in Brazil. The foreign company is the company here in the United States, AMC Entertainment. The shares of the foreign company, in this case AMC, are already legally issued, outstanding, and currently trading in the U.S. and are blocking the account of the program's custodian institution. These BDRs are unsponsored by AMC and they have no involvement in the listing of the BDRs. The difference in outstanding shares, as reported on the Brazilian exchange, is a conversion rate calculation. 6 AMC BDRs is equal to 1 share of AMC Class A common stock. This is not a conversion of the Brazilian real to the dollar, but a conversion of the number of BDRs that are issued to the stock of Class A common stock of AMC, the underlying asset. Right? They've chosen to report the conversion on shares rather than the foreign exchange rate. There you go. Plain and fucking simple. And Citigroup owns a fucking metric shitload of them. They have a shitload of Brazilian depository receipts, and they can create more at any time. And I hate to break this to your ComputerShare users, but ComputerShare has a subsidiary by the name of Citigroup. And Citigroup can keep your shares nice and safe, under their, as a custodian institution, locked away, because they're a subsidiary of ComputerShare. And your shares are safe. But you won't be able to sell to anybody on the market. You'll only be able to sell to other ComputerShare users, because ComputerShare is not a broker. And I hope no one's getting upset with me if you don't feel that I'm correct here, but I've looked up all the documentation. I've read everything, all the terms and services and terms and conditions of ComputerShare, as well as the direct registration shares. And I personally believe that it's not in people's best interest to use those things unless, and again, this is going for GameStop mainly, unless they don't plan to sell those shares during a squeeze. If you want to keep them for post-MOASS, I think then it's a good idea to maybe DRS a couple shares. Nothing wrong with that. Not financial advice, and I'm not a financial advisor. But I have read the fucking documentation top to bottom, inside and out, on all of these. And I'm not a fan of either ComputerShare nor DRS personally. But to each his own. Ryan Cohen can ComputerShare register his shit all he wants, because he's not going to fucking sell them anytime soon. There's nothing wrong with that. Nothing fucking wrong with that at all. Where's my fucking BDRs? They're in here somewhere. Here you go. This is Banco de Brasil's B3 identification on the Securities and Exchange Commission. They are I should move this over this way. They're the custodian institution. The depository institution is Banco B3, and the custodian institution is Citigroup. And through these, they're able to create depository receipts in Brazil for Citigroup. Here's the information: Citibank NA out of Greenwich Street in New York, New York. They also do this with every other fucking bank you can think of. They do it in Brazil, Germany. They do it in Europe, all over the place, in South America, every fucking market they can get, in Asian markets, every single place that they can get away with depository receipts, which is everywhere outside of the United States. Because in the United States, Dodd-Frank regulations don't allow them to manipulate things in the same way as they do outside of the United States. So what did these hedge funds do? They took the information. The hedge funds decided to say, we're going to play ball the exact same way as we always have, except now we're going to do it overseas so that the CFTC is in charge, and Dodd-Frank regulations aren't going to mean shit to us. It's a fucking joke. So as much as I think that, Gary Gensler and company are trying their best, there's only so much they can do when they're facing, these 182 trillion in derivatives here in the U.S. markets. And I'm sorry, not in the U.S. markets, but 182 trillion derivatives plus the 245 trillion additional in offshore holding companies and shadow banking sector. These are the financial runs that my girlfriend, old Yeller, promised us. All right. And she told us that there's concerns that there will be financial runs because of this stuff that we're looking at right now. When you only have 18.6 trillion in assets, but $244.3 trillion in liabilities, in total derivatives, that's really bad fucking shape. That's a financial meltdown. That's a financial crisis that nobody wants to believe, and nobody will believe until it occurs. And that's what makes us ahead of the game and ahead of the ball here. I hate to fucking say it, but after the fact, everyone's like, I can't believe, how did we not see these mortgage-backed securities in 2008? It's the same fucking thing now, guys. It's the same thing now. Same collateralized debt obligations, except they renamed them super senior synthetics collateralized debt obligations, because they've had to rename them so many times. They keep giving them more acronyms. They're now known as SSSCDOs. They got $133 trillion worth of swaps, $45 trillion worth of forwards. It's a ridiculous amount of numbers that they're fucking playing with. And that's just in the shadow banking sector. You look at another $106 trillion worth of swaps alone inside, in the actual banks themselves, not in the shadow banking sector. Another $33 trillion in forwards, $31 trillion in options contracts. $31 trillion in options contracts. They don't even have $31 trillion in fucking assets combined. They've only got $20.48 trillion in assets. How the fuck do they have $33 trillion in total options contracts? Come the fuck on. It's too fucking simple at this point. It's too goddamn clear. It really is, and it's so fucking sad. I'm so irritated that so many people are not seeing this. But like we were discussing in the Discord earlier, you can lead a horse to water, but you can't force him to drink. You can teach a man to fish, but it doesn't mean he's going to pick up the goddamn fishing pole. He might just stand there with his hands out and say, when MOASS, when Lambo, and wish for the best. Good fucking luck. This post is from a Reddit user, Tywin, Ty_WINN. It's let me post it over here in the chat because it's actually a fantastic, well put together Reddit that, in my opinion, is being suppressed. It's a Reddit post that is being suppressed heavily, and I truly do believe that that's on purpose, because what he's saying here is so on point that a lot of people don't want the Reddit user to know, right? So check this shit out. Due to ongoing market volatility, the following securities are currently set to position close only. As you can see, AMC among other heavily shorted stocks, GameStop, Cost, Naked, Sundial, TRVG. my man Samuel Clemens goes on to say, I believe they were the most momentous stocks at the time, and all were potentially part of the same ETF, the Russell 2000, IWM. If they didn't take away the buy button when they did, the entire IWM ETF would have been artificially inflated by GameStop and these other tickers. At the time, GameStop was still in the Russell 2000 in January. And as of right now, GameStop has been moved to the Russell 1000 and other ETFs, while AMC and others remain in the Russell 2000. However, AMC, I think, has made the cutoff for the Russell 1000, and this coming year, it should be moved into the Russell 1000, I believe, at its current valuation, not even counting for a squeeze. So these are just a few headlines helping showcase that GME shot to the top of the Russell 2000. You know, GameStop's boom briefly vaults stock to top of Russell 2000 by Bloomberg. Another one, Bloomberg Quint, same fucking thing. Investor Place. What did the stock market do January 29th, January 28th? GME stock, perhaps spurred on by the Robinhood revival, is up 80% and back over $300. Yep. GME over. The daily rip. Tail of the tape. Good evening, folks. Once again, the market was madness. Traders got restricted from trading, and the internet went absolutely insane. The Russell 2000 was the only major index to finish in negative territory. The Dow nearly gained 1%. Every sector settled in the green. Why did that happen? Because the buy button was pulled on GameStop and AMC, as well as other stocks, BBBY, Cost, Naked, Sundial. Again, he goes on to say that the artificial price or squeeze of the Russell 2000 manifests itself on February 8th and the surrounding days of stocks in the market. Check this out. What happened on February 8th? Just a week later, after the January 28th buy button, and right around the same time that the buy button was brought back for GameStop and AMC, because they went position around 12 different stock broker-dealers went position close only and did not allow people to buy AMC or GameStop, among others. Check this shit out. Ocugen Inc. Up 5,259%. Does that sound like financial runs? Bionanogenomics went up 2,894%. Vaxart, 347%. Tilray went up 1,000%. Kronos Group, 188. New Age, 472, and so on. Hexo went up 264%. So Ocugen can go up 5,259% on February 8th. But people are worried that AMC or GameStop might not run. People don't have enough conviction. Bionanogenomics ran up, was worth 50 fucking cents, and it ran up to $15.57, 2,894%, and it's gonna run again probably. But I don't think that these were allowed to run because the losses here on this 5,000, 3,200% gains and 678% gains were less. The hedge funds lost less by covering these instead of AMC and GameStop. AMC and GameStop would have caused an entire market collapse because the entire IWM would have had to be, all those shorts on IWM and everything inside of it would have had to be, closed out, causing these companies to go completely fucking bankrupt. CPS Technologies went up 1,419%. Gevo, 1,388. Orbital, 1,250%. You guys remember when AMC and GameStop were worth $2 or $3? You remember when Deep fucking Value was buying GameStop at $3? Look, Foresight Autonomous, 1,000% gain. Senseonics, all of these happened on February 8th. Aurora Cannabis, 385%. Caustic Pharma, 500%. Top Ships, 256% one day. Oncova, 500%. Does this look like an accident to you? It was cheaper for market makers and hedge funds to cover losses on all of these stocks than AMC and GameStop combined on January 28th. All of these stocks covering was less expensive than covering AMC and GameStop combined. Do you understand? This is fucking bullish, guys. I cannot stress that enough. June is when the Russell fund indexes were rebalanced, and when they did that, they removed GME from the Russell 2000, but AMC remains in it, and it remains in IWM, and it also remains in all of these other fucking shares. I'm sorry, all these ETFs, and there are 12 million AMC shares in IWM alone. And Webull, there are 44 Webull retailers in Webull alone own 44% of the entire fucking float. Then you got another 12 million over here in IWM, another 5 million here, 10 million there, 15 million here, 5 million there, and just go on, keep adding them up. Then you got the ones that hold both AMC and GameStop right here. And then you've got all of these here on the top, right above my head, all of these right here that hold GameStop. Right here. So what occurred was, by pulling the January 28th, the buy button on January 28th, market makers and hedge funds managed to keep themselves alive just that much longer. And right now it's been almost a year. It's been about 11 months since then. And we're getting to the same fucking place that we were then. Same fucking place. This was yesterday, okay? This was yesterday, the IWM, the 8th and the 9th. They had 400,000, 100,000, 1 million shares available. And I showed you already that today, there as of today, Friday, December 10th, there are 0 shares left as of the end of the day. 0 shares left of IWM to short. So there's no more availability. So I believe truly that we're going to see another run-up coming extremely fucking soon for these stocks. So failure to deliver data is about 30 days old, 35 days old, because it's T35 reporting for FTDs. This is the failure to delivers for IWM. As you can see here, back in December of 2020, prior to the January run-up, the failures to deliver for IWM were almost 9 million. They were 8.5 million. That was the month before January. And then here in May, right before the June run-up, we see that there was around 4.5 million failures to deliver. Then in September, there was over 9 million failures to deliver. And I truly believe that these FTDs have not been returned. And while they were rolled somehow, in one way or another, because they're not on the FTD aggregate data, that doesn't mean, because all these numbers are added and subtracted from daily and monthly. So this did go down. But that doesn't mean that they returned these directly, these failures to deliver. They could have been washed in a variety of factors. And I can guarantee you that, sorry, I shouldn't say that. I've got a lot of money riding on the fact that these haven't been fucking closed out or returned or truly settled just yet. And they're out there hiding around as married puts on the options chain, hiding. And that's okay, because they'll come up at some point. They have to. All shorts All synthetics will be closed out, but it won't be like you guys think. It won't be when the hedge funds give up. The hedge funds are not going to fucking give up. It's going to be when a liquidation occurs and a margin call happens. But not just any margin call. It's going to be a cascade of margin defaults and true liquidations by the DTC and prime brokers of these junior and senior hedge funds, until it escalates to the point where we see Lehman Brothers 3.0, Goldman Sachs, Bank of America, in my opinion, are extremely likely to go bankrupt. Even my friends over at macroaccess.com believe that they're going to go fucking bankrupt. Macroaccess.com gives Bank of America preferred shares a 75% chance of bankruptcy, according to their scores. Here's further failure to deliver data. This is October of 2020, December, and early January of 2021. I'm sorry, that's 19. Here's 2020. This is the November 2020, December 2020, right before the January run. Then we've got May of 2021, before the June 2021 run up. And then I see it's hiding in the corner. Let me slide it over for you. This massive bar that we've got here is September. Way up here at 9 million, higher than ever before, FTDs on IWM was in September. And even though it's hiding right now, just like it was in between here and in between here and in between here, eventually it has to come back. They rear their ugly head. And we've got to the point where the September data is probably, now that the November data hasn't come out yet, because we've only got the data through November 1st, because again, this data's got to be 35 days and older. It's the only data we get for failures to deliver. You can see it's, the next one is probably going to be another dual bar of 9 million plus FTDs showing up here in mid-November, which, just like it did back then, delayed about a month. Looking down here, that's 2019. Let's go to the financial run that we had. Again, here's November 2nd. Here's December 4th of 2020, where we had these massive IWM candles of 8.5 million. Let's look at this lag time, an entire month here in between. And then over here, we've had more. We had several million more, and then a huge 3-month lag right here. Another longer lag, but the longer it takes, the higher the FTDs end up shooting up. So the fact that we had 9 million on this date and it shot down to nearly no FTDs on these dates means that the next candle here in November is probably going to be 9.5 million plus failures to deliver for IWM alone. Alone. Does that make sense? Is anybody not following me? You guys still hanging in the Discord, or everyone fall asleep on me?
Oh,
Yeah,
man, you're killing it.
I'm on a fucking
Like
roll.
literally.
I'm on a fucking roll. We can go all night.
It's the financial stability that have come from the growth of activity in the shadow banking sector.
Oh shit! Did you hear what my girlfriend
We
said?
saw some of those threats emerge.
Are you just in the Discord or are you
during
on?
the onset
I'm live,
of the
brother.
Pandemic.
Okay.
We have.
We're live
for
with 1,000 plus
example,
people right now on
banned,
Friday night. Looking at my
bond
girlfriend
funds
talk about
to
financial fucking
guarantee
runs because
daily
we're gonna be fucking
redemption,
rich. God
massive
damn!
withdrawals,
So
and
goddamn
individuals who want to
rich.
cash
Filthy
that
rich.
can trigger fire sales of assets
God damn right. This is the part where she says that
with
these financial these
systemic
can trigger fire sales of assets.
consequences. The Financial Stability Oversight Council that I head has taken that up as
You already covered the
a
DOJ
topic that
Hold on,
coming
brother.
in for
Let
another.
me play this video. I need you to be silent for just a moment, please.
we're
Yeah.
looking at and examining. There are issues relating to hedge funds and the possibility of leverage there that
Come
can
on.
trigger.
You fucking see that? My fucking girlfriend's telling you exactly what's going on.
That's another topic. And more broadly, climate change
Old fucking Yeller is telling you
wanted to fleece
exactly
cash,
what we just talked
and
about
that
in front of
can
Congress.
trigger fire sales of assets with systemic consequences. The Financial Stability Oversight Council that I head has taken that up as a topic that we're looking at and examining. There are issues relating to hedge funds and the possibility of leverage there that can trigger financial runs.
Oh my God. How fucking rich are we going to be, guys? Jesus Christ. How fucking rich are we going to be, Cash?
We're going to be so rich, we're going to be able to afford to pay her and come and talk to us.
Janet Yellen is going to be paying speaking fees to join our fucking Discord and talk with us about these financial runs after the mother of all short squeezes occurs.
Man's money printer go boom.
That's right. Get the goddamn money printer out, J. Pow. Let's fucking go, man. This is, look, where do all these FTDs go? They're put into options. They're put into options. And who holds these married puts? Who holds these options in IWM? Susquehanna has 34.5 million short shares through put options on IWM. Do you see? Do you see? Barclays has 32.8 million. Parallax, 24 million. Citadel, 21.8 million. They've all increased their number of shares. Look, Susquehanna bought 36% more. Barclays, 1.8. Parallax, 24% more. Citadel, 15% more. Bank of America sold almost 17% more, probably because they're going fucking bankrupt and they need assets. UBS Group has increased their percentage of shares by 106% of this. Please mute your mic if you're eating on stream. I don't care, but you know, a lot of people listening. Credit Suisse, 13 million. Jane Street. So if you guys don't understand why your shares and your stock seems to be going down, even though there's no shares left to fucking borrow, this is why. This is one of the reasons why. Plain and fucking simple. As of December 8th, check this out. If this isn't bullish, I don't know what the fuck is. Where the hell are we at? My man, is that you, Reaper? Need you to mute the mic, please.
Yep.
Thank you. Come on, computer, keep up with me. What the fuck? I'm only streaming live. I'm only streaming on Discord and on Streamlabs as well, on YouTube, Twitch, all at the same time. Yeah, that's not going to cause my computer to run slowly. This is the historical short volume for IWM. And on December 8th, there was almost 4.5 million shares shorted. That was 71.27% of all volume on IWM. Almost 3/4 of all the fucking volume on the Russell 2000 ETF, iShares, stock ticker symbol IWM, were shorted on December 8th. So if you were wondering why AMC didn't run more than you expected or actually came down, this is why. Plain and fucking simple. Plain and fucking simple. And every other day in between. Look, 68% short 40%, 60, 58 short volume percentage, 63, 40, 52, 41. To be at 71%, it means that something is on the horizon very soon. Something interesting is about to happen. And I'm not sure exactly what it is, but I've got a pretty damn good idea. I think it's going to include financial runs on AMC and GameStop. Yep, that's what I think. That's what I fucking think. Here's another source with short volume exchange. On December 9th, the short volume reported was almost 62%. Curious why Avis. You guys remember how Avis squeezed? And supposedly it was based off of fake news regarding Tesla cars. You guys remember that shit? No? Nobody remembers? Anyways, if you guys didn't know, Avis squeezed in November. And it was blamed on fake news of somebody saying that Avis had made a deal with Tesla. And that wasn't the case. But that squeeze made Avis the second largest holding in the IWM ETF, the Russell 2000 ETF. Okay, this is what's going to continue to happen, and what's going to get even worse. Here my man continues to say, I believe its squeeze on November 2nd is what contributed to IWM's increase on November 8th, after which they had to short IWM again heavily to compensate for that stock and the ripple it caused. Makes a great point. When that motherfucker went up 284% in one day, that wasn't just FOMO. There was gamma squeezing and delta hedging occurring right there. And to bring it back down, to prevent this from looking like a heavily shorted stock, IWM had to be shorted. What happened on November 8th there? It caused the entire iShares Russell 2000 ETF to go up by almost 26%. He says, Samuel says that they tried to disperse the pressure of AMC shorts by shorting ETFs, and it's come back to bite them in an insane way. They've created a compounding effect that will amplify and magnify our squeeze even more with the pressure built up from within its ETFs. And he continues to say some other things, like go ahead and try to poke holes in it. And I already have. I've fucking looked at this up and down. And it looks pretty fucking clear to me what's going on. This is already what I knew was going on and what I've seen been happening on lots of ETFs. So when I saw this post on Reddit, I liked it right away. And, oh, sorry, I'm not logged in right now. I liked it right away and I've been sharing it, but it's getting absolutely no traction because there's no organic traction on the best posts. All of the best posts are suppressed on Reddit at this point, without a doubt in my mind. And even still, only 70 people or so have upvoted it, but that's 99% of all the people that have seen it. Okay? So this is proof to you, if you don't understand that Reddit is partially owned by Citadel and Company, Reddit is being controlled, and actually good, truthful, and verifiable information is being suppressed. 99% of people have upvoted it. That's 70 people that have clicked that button up or down. But this was posted hours ago. Yet in the meanwhile, if you go on there and post a meme, it'll get 10,000 fucking thumbs up votes within moments. Because they don't want real information being shown. You know, I was the first one to hop on and be like, yo, this shit needs more eyes. You're on the fucking money, man. You're on the money. But look, he literally comes out and tells you it got rejected on several other subreddits. And I know. Because everything, whether it's related to AMC or GameStop or not, or a meme stocks, the stock market, the economy, you name it, even r/conspiracy, I've been fucking banned from it for posting stuff like this. So I don't do much Redditing anymore. Although I do have a lot of work on Reddit myself. I mostly share it on Twitter and the Discord and this YouTube channel because I can't stand the way that real work is suppressed on Reddit. So if you're out there, do me a favor and please share this. I'm going to drop it into the the chat here on this video just so other people can see it. And yep. Again, and how do you know that these banks are actually losing money? The second quarter trading revenue was 23% less than the first quarter of 2021. Trading revenue in the second quarter decreased by 41% compared with the second quarter of the year prior. So not only is it down 41% from 2020 second quarter, it's also down 23% from the second quarter from the first quarter of 2021, showing you continual downtrends in the banking sector and actual profits and revenues. What a goddamn joke. It's fucking sad. If you wonder why I keep stopping when I'm talking about this stuff, it's because talking about this is actually really difficult. When you understand the gravity of the situation, it's really out of control, and you should be concerned. Not for your own well-being, I guess, if you're invested properly and invested in stocks like AMC and GameStop and other things that are run inverse to the market, but mainly for the majority of other people in the world and retail investors that are potentially going to lose their entire life savings and pension and 401k. Because that's a very real thing that could happen here, even though a lot of people don't see it. So yeah, play around with your brokerage apps. Maybe you'll get lucky and be able to sell $69,000 per share or more, $690,000 per share. Anything's possible. For those of you guys, if you're wondering how many, do you want to know how many synthetics I think there is? If you take up all the ETFs that I've showed you in this hour-and-a-half long video, and you take AMC and GameStop and all of their synthetics and failures to deliver, married puts, divorce puts, shorts marked as long, depository receipts on these stocks, I wouldn't be surprised in the slightest bit if there was 30 or 40 billion shares of synthetic shares of AMC, another 30 or 40 billion of synthetics on GameStop. Some people go, well, why is it, do you think they have the same amount of shares? Because, when GameStop's been potentially being shorted since 2005 and AMC's been being shorted since 2007. The reason I think that is because GameStop's got a float of only 78 million. Therefore, GameStop is still shorted and has more synthetics than AMC because it's only been shorted, because it has a float of around 513 million. So percentage-wise, there's multiple percentages more of shorted stocks of GameStop than there are AMC, in my humble opinion. But being realistic and adding up the shares that I found on Webull and institutional shares and retail owning the float and all these ETFs and these married puts, these divorce puts, these 5.2 billion married puts on AMC and 5.4 billion married puts on GameStop just from January through today, I truly believe there's got to be 30 to 40 billion of each of these stocks, both AMC and GameStop. Not just AMC and GameStop, but IWM, IWN, IWV, all of these fucking ETFs that hold the Russell 2000, the Russell 1000, and both AMC and GameStop together. All of these combined, in my opinion, lead us to this 30, 40 billion synthetic shares. Now, it's not hidden in the FTD data directly. It's hidden in everything else that we just got done mentioning. The wash sales, the ladder attacks, the short ladder attacks, as people like to call them, they're occurring every single day. They still are. But it costs Citadel and Company and Virtue and these other guys 27 cents or 28 cents to create one of these. That's nothing. That's nothing. To make a wash sale, to spend 28 cents to profit many, many dollars is just the cost of doing business. popping this information in the comment section right now and on the chat for everybody. I apologize if I haven't answered any questions. If you want, drop me questions right now. I will answer questions for the next 5 minutes gladly. Gladly. Because I hope to see everybody making this kind of money per share. And if you want my honest opinion, I think there's going to be fractional shares of AMC that sell for anywhere between $1.2 and $1.7 million per share. I think some people are going to sell half a share of AMC or GameStop for $1.5 million. So that half a share might bring them in $750,000, $1 million plus. One half of one share. Do I think that'll happen to everybody? No. Only the most diamond-handed motherfuckers out there. And I don't think there's anything wrong with securing profits on the way up. I don't think that makes you a paper-handed Portnoy bitch. I think that makes you a smart investor. But again, I'm not a financial advisor. Do whatever the fuck you want. We're going to the goddamn moon. I don't even know what the fuck else to fucking say. The married puts, Barry, are... You can say that again, brother. As a matter of fact, say it again for the people in the back.
So goddamn rich.
So goddamn rich. We're going to be
money.
fucking ridiculously rich. It's going to be fucking insane. It's going to be insane. You're going to see dollars that you've never fucking knew existed. You're never going to know that your bank account could possibly have that many commas. God damn. I understand a lot of people don't believe. That's okay. Nobody believed Michael Burry before the 2008 stock market crash either. And he became a fucking multi-billionaire because of that. All of his investors that wanted to pull their money out but couldn't, it wasn't because he was doing poorly like Lehman Brothers. It was because he was doing really well. And they were feeling the head fake. They were feeling the head fake right before the financial run. And we are on the precipice of our financial run. Nothing can convince me otherwise. Because it's not confirmation bias. It's due diligence. And it just stacks up, and it just continues to build. Because it's one after the next, and we can see it. Citadel recently has changed their withdrawal limits. So investors can only withdraw 6.25% at a time. And they must only be able to do that once per quarter. That means that it could take up to 4 years to withdraw all your money from Citadel. It's a lot of fucking money. AMC and GME to the Moon asks, what do you think about GameStop mentioning how many shares retail investors put in a computer share during their earnings report? I mentioned this earlier in the stream, but I understand that was a while ago, so I will recap by saying that just like insider shares or anything else, that's something that GameStop had to report just because it's a form that needs to be filled out and reported. So if GameStop knows that there are shares in computer share because their insiders put them there and other people decided to do it, they still have to fucking report that stuff. Hector Figueroa says, hey, Marcel, my respect for your work. Thank you. Why has IWM been showing a bid-ask spread of $2,700 during after hours for weeks now? Probably because so many people nobody's fucking selling IWM either. People are holding on to it, and the bid-ask spread is getting out of control. It's not just Citadel. It's State Street, Susquehanna. It's all these other fucking guys. You want to see who? We'll fucking pull them up right now. BTG Pactual. Fucking groups of crooks. Yeah, you heard me, motherfucker. Crooks. Yeah, you. Son of a bitch. Look at these assholes. Constancia Investimentos holds 720,000 put options in multiple portfolios of GameStop. Capitalo, 397,900 put options. So you got to multiply that by 100 because every option is indicative of 100 shares. So that's 3.97 million and 7.2 million. That's a ridiculous number of shorted shares. Put options, I should say. BTG Pactual Asset Management with 22,000 shares. They're straight fucking crooks. And this isn't hearsay. I'm not worried about getting sued for this at all because they are literally fucking crooks. The owners, the two CEOs, one was of BTG Pactual. One of them was caught for the world's largest Italian insider trading scheme, and the other one for the world's largest French insider trading scheme, and they're both restricted from doing business in those countries. This is the Brazilian senator and the CEO of BTG Pactual, who were arrested for corruption charges. Banker André Esteves, the billionaire CEO and controlling shareholder of BTG Pactual, was arrested at his home in Rio de Janeiro years back in 2015. And in Delcidio de Amaral, 60-year-old Brazilian senator, was also imprisoned for accepting bribes from these people. As well as oil firm Petrobras was also, caught in one of the world's largest money laundering schemes and bribery schemes. So these guys have absolutely no fucking problem doing things like this and trading off hot potatoes of shares. Let me scoot this over in case it's being blocked off by part of my screen. I don't know how I changed pictures, but I'm cool with that. Right? So if you're still not sure as to why these things are happening and why the short interest isn't showing up directly on these stocks, it's because it's being hot potatoed around the world from Simplex Trading, Susquehanna, Jane Street, Citadel, Group 1, BTG, Constantia, Wolverine. All these fucking assholes are playing the same game. Barclays, UBS Group. UBS Group holds a lot of Evergrande junk bonds, as does HSBC and BlackRock. And Citadel Advisors holds heavy positions in UBS and HSBC. This fucking guy. Thanks, Artie, for sharing this awesome information on Charles Schwab as well. And for those of you that aren't aware, raw beta for AMC over the last year to date, is negative 9.8. That means it runs inverse to the market. GME negative beta is negative 13.73. These are Bloomberg figures. That's very, very inverse to the market. Let's put it that way. That's highly, highly leveraged to, even though, in my opinion, at first, like they are right now, they will run with the market. Eventually, the liquidity will dry up and shorts will be forced to cover. Synthetics will be bought back, and it'll cause an absolutely massive financial run. If you're unaware, Dr. Marco Metzler, former analyst for Fitch Rating Group, stated that BlackRock, iShares, and others are benefiting from the Fed's special programs to buy Asian junk bonds, ETFs. We managed to work together, even though we are on opposite sides of the world, in order to come out with some incredible information regarding these junk bonds. The Fed is providing these special purpose vehicles through which ETFs from BlackRock, such as iShares and others that hold these Asian junk bonds, can be abused and used many times over. And companies like Ashmore Group, who continue to buy these bonds, are using and abusing them even further. And they will continue to buy them because the collateral value, for example, here the nominal value is $500 million worth of Asian bonds, but the market value is only $100 million. However, this is still worth $500 million in nominal value bonds as fully accepted collateral to show capital for hedges in the market like AMC and GameStop. Mic drop. Got nothing else left to fucking say. I can go on for another 7 fucking hours talking about this fucking shit. If you don't understand what is happening here, what the fuck are you doing in the stock market? God damn, we're gonna be fucking rich. Unfucking real. This is ridiculous. The over leveraging that's happening in these fucking stock markets is not just crazy, it's fucking criminal. It's insane. It's fucking insane, and we're gonna be fucking rich.
Get the money, Kenny.
Dollar bill, y'all! Get the fucking money printer out.
So goddamn rich.
I think it's time to blow this thing.
That
Get
over
everybody in the
wrap
stuff
up. You
together.
guys, much love to
Okay,
everybody.
3,
Peace
2,
and well.
1, let's go.
Getting fucking rich.
Drop a goddamn like. Thank you.
Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich.
Great.
Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling, give me the fucking money. Get the goddamn money printer out.
Great.